How we doing, everybody? Today is Saturday, June the 24th, 2023. We're starting our series on real estate note investing. We're going through that as well as seller financing. It's kind of like a training information on these two real estate strategies. We feel that because of the changes in the market, these two strategies are going to work well if you are investing in real estate, thinking about investing in real estate, if you are a homeowner, thinking about selling a property, if you're a buyer thinking about buying a property. These strategies will help you in doing that, accomplishing what your goals are. So we're just breaking down real estate note investing piece by piece. We're not here too long. We just try to give you bite-sized pieces of the information from week to week. We'll kind of go through, why invest in notes. We'll talk about what is a note. We'll talk about how we evaluate different deals. We'll talk about, the due diligence process, some of the paperwork that's involved. So we're just going to break this thing down from week to week. I don't know how many weeks it may take, but, we'll break it down from A to Z, week to week. 12:30 Eastern Standard Time here on Facebook Live. Also, I'm on Instagram Live as well at Abundant Capital Group. If you aren't able to make it, you can always go to my YouTube channel, which is at Abundant Capital Group. I'll label this new real estate note investing and seller finance series, and you'll see this series on there as well. You'll see some videos on there as well if you want to check those out. But that's what we're going to be doing over the next few weeks. If you have questions, if you watch the replay, have questions, you can post them here on my social media, or you can reach out directly. If you watch till the end, I'll leave my contact information. If you want to send me a text message or an email, I'll put that at the end. If you do see this on any of the social media, just comment with any questions that you might have, and we'll get those answered for you.
I didn't get that. Could you try again?
You can also catch me Monday through Friday at 12:30 Eastern Standard Time on Instagram Live at Abundant Capital Group. If you have questions, if you have a minute, if you're at work and have lunch or have a break and you have a real estate related question, you can catch me there from 12:30 till about 1. Usually not on there too long. You can ask your question, and if you have a problem, a scenario, something like that, we can try to help you work through it. A lot of times seller financing and real estate notes can solve whatever issue that you may have on a particular property, but we also just try to give our knowledge, our experience level. We've seen a lot of things. We've been in real estate for a long time, seen a lot of different markets. This particular market that we're in, we kind of I've never seen before, but we feel that real estate note investing and seller finance strategies are going to work best. So with that being said, let's start. So why notes? The reason why we want people to look into real estate note investing and also seller financing, and seller financing is just creating a note on a property. If you own a property either with a mortgage or free and clear, you have the ability to create a note by doing seller financing. Basically, you are creating financing for a buyer. You're not actually giving them a loan, so to speak, in this instance, but you are creating financing for the person. And that can either be what they call wrapped around existing financing or existing loan that's on a property. That would be called a seller finance wrap. Or if you own the property free and clear, you can create a real estate note on a property that's free and clear. And so, why we talk about notes is because it has low risk with a high yield. That's like the first reason. I mean, the reason why there's low risk is because we protect ourselves in each of these deals. You always buy at a discount. How big of a discount just depends on who the seller is when you buy real estate notes. Then when you buy at a discount, that will increase your yield. Why we say too it's low risk is because you always have the property to kind of fall back on. In worst case scenario, if something goes wrong with the person that's living in the property or who you gave this financing to or created this financing for, you always can get back the actual asset. And then you have the ability to do some other things once you get the asset back. Sometimes you can get it back voluntarily by the person that's living in it. They can, what they call sign a deed in lieu. They can give the property back to you. Or if you have to, then go to foreclosure, you have to take those steps. But eventually, at some point, you will get the property back. So a lot of investments, if they go bad, you really, don't have a tangible asset. I guess, obviously if you invest in silver and gold, you can have that as a tangible asset, but stocks, bonds, things of that nature, you don't have an actual physical tangible asset, with those types of investments. So, because we're buying at a discount based on what the value of the actual real estate is, the property is, you protect yourself. It's really hard to lose out when it comes to notes. Not saying that it can't happen, but you just have to really make just a terrible purchase in the beginning for you not to be able to make money some way, somehow, with real estate notes, or creating a note on a property. So, that's one reason. You have low, like we said, and there's low risk on that. You know what I mean? Because you can always get the property back and be able to do something with it. Now, what is a note? A note is basically an IOU. It sets the terms of how someone is going to repay you for a particular piece of real estate. So if you have a property and you create a note on it, you're going to create what they owe you in terms of a purchase price, and for just round numbers, let's just say $100,000. It's going to say the note is going to say how much they put down. So if they put maybe $5,000 or $10,000 down, and then you create the note for the difference between that purchase price and whatever they put down. So in this case, let's just say it's $90,000. It tells you the interest rate, whatever interest rate you feel comfortable with. You can set for the person, and then it tells them how many months they have to pay that back. Now there are different, when you have a note, you also have a security agreement. We're not going to get into the specifics of the security agreement today. We'll handle that, as we go forward. But just to explain what a note is, a note goes with a security agreement, meaning that, if something goes bad with this note, here's your security agreement that you can go, after and claim back if, the person stops paying you or can't pay you or for whatever reason like that. So they go hand in hand. So it's basically an IOU that spells out, what it is that they're going to have to pay you, how they're going to pay you, when they're going to pay you, the first of the month, 15th of the month, whatever the case may be. It all spells it out in that note. And that's what you have the ability to create and then also to buy. And that's what you're buying. You're buying this paper. You're buying this IOU, so to speak. So if you do buy it, you're taking over wherever you purchase. A lot of times notes will go 360 months, 240 months, 180 months. So wherever you buy a note within that time frame, that's how many months they have left to pay you. So if they've been in the house 12 months and it was 360 months, so now they have 348 payments remaining when you take it over. So, that's what a note essentially is. It's basically an IOU, and they tell you and they give you, they spell out how this IOU is going to be repaid to you. So what can notes do? What can notes do when you invest in notes? They can create wealth, and they can create monthly income. You can buy notes to be able to get a lump sum of money, or to collect monthly payments. So there is, as we talked about with the IOU, it spells out how they're going to pay you, when they're going to pay you, and things like that. So a lot of times people invest in it for what they call the cash flow, the month-to-month payments that'll be made to you. Sometimes people invest in notes to make lump sums of cash. And, without getting into the too specifics, we just want to stay with some of the basics right now. You have the ability to buy a note a certain way and then be able to sell it for lump sums of cash. So it all depends on, what it is that you would like to do, but you have the ability to get lump sums of cash as well as monthly income. And with notes, you want to think more so about amortization as opposed to appreciation. When you, a lot of people think about appreciation. They buy a property today, 2023, hoping that in 2033 the property has gone up in equity or appreciation. Amortization is kind of like the opposite side of that, where when you create a note and you create this IOU, as the person makes payments, there's still an unpaid balance that's remaining to you as the bank. If anybody has purchased a home, you probably understand that concept where the bank loaned you a certain amount of money to purchase this home. You're continuing to pay them back. At some point you sell the property. There's still some money that is owed to them typically when you sell a property. And the purchase price of the property, whatever that is, the first part of that is going to go to the bank to pay them off. And anything over and above that is considered your equity or your appreciation. And that's what most people try to, invest in real estate for, the appreciation, and a lot of times the cash flow as well. But with amortization, that's the kind of the opposite side. It's like I said, there's a certain amount that's still owed to you after a certain period. When a person sells the house, if they refinance the house or whatever the case may be, there's still an unpaid balance that's owed to you as the bank. And as appreciation, as we're starting to see now, they've made a lot of gains over the last few years in terms of appreciation and equity in properties. Now we're starting to see maybe things taper off a little bit and possibly come down in the near future. So if you did not cash in on your quote unquote equity or your appreciation, it actually goes away if the market changes. People don't really think about it, probably that way. They think that, they have X amount of dollars, over and above what's owed on the property. But tomorrow, 6 months from now, 12 months from now, that money can actually go away. And you didn't physically have it. You thought you had it and it went away. But if you're on the amortization side of things, you don't lose amortization. Amortization doesn't go away unless you as the bank choose for it to go away or you make any type of adjustments on it. So you're protected again on the amortization side of it, that after, in this example of a $100,000 property, you put $10,000 down, you have $90,000 left. If you were to go on an amortization schedule, which I'll do here, let me just share can I share my screen on here? I don't know if they allow you to share your screen on Facebook. I don't think they do, so I can't share my screen on Facebook. But if you go to a amortization schedule, and if you just Google amortization schedule, you put in $90,000, pick an interest rate. Right now, interest rates are around 7%. Just put 7% in there. Put 360 months, and then what you can do is solve for the payment. And then you can look at the actual schedule. And it'll show you after each payment what the unpaid balance is on an amortization schedule. After 5 years, a lot of times on a $90,000 unpaid balance, there's still like $85,000 left. So in that 5 years or 7 years that you've owned the property, you've only paid down the principal maybe $5,000-6,000. And because in the front of a loan is mostly interest that you're paying. If you look at how it's broken down, and if you own a home or something like that and you look at your statement, if you look at the amortization part of it, you'll see how much goes to principal and how much goes to interest. And you really don't start paying mostly interest until like after like 15 years. So for the first 5, 6, 7, 10 years, you're predominantly paying interest, and there's still a considerable amount left on the amortization schedule for the unpaid balance. And that's why, another reason why we really like note investing, because of that unpaid balance. And after, however many months, you're still owed a lump sum. So you can get money up front. You gotta, in that example, that $100,000 house, they put $10,000 down. That $10,000 is yours. That's their down payment. That's yours. You keep that. That's money in your pocket. Then you have a certain amount of money that they pay you each month. So now you're collecting monthly payments until they decide to either refinance or sell the property. You collect them for that period. And once that refinance or that sale happens, there's still a considerable amount of money left over, a lump sum for you in the future. So there's 3 profit centers there. So, when you just have a rental property, so to speak, you're just waiting for appreciation and, building equity, and you're collecting those payments. But a lot of times you're only collecting security deposits from the tenants. And then a lot of times you have to use that security deposit to fix the property and to do things like that once this particular tenant moves out or whatever the case may be. So there's really only 2 profit centers there, your monthly passive income, and then if the property appreciates. But again, appreciation can go away. So, just to kind of start this off and start this series off, we just wanted to give a foundation on why we like notes and what a note is. And as we continue to go along on this, we'll, get into the documents and different things of that nature and how we analyze deals and stuff like that. But we just want to make an introduction into real estate notes. A lot of people do not know, about it, may have heard about it, don't have, a lot of information about it. So we just want to make people more aware, especially now going into this particular market that we're going into. You might want to pivot, if you are already investing in real estate, to looking at notes, looking at the different notes that you can buy. If you have a retirement account, I think it's a really great investment for entire retirement accounts. If you have children, you can possibly set them up with retirement accounts, and have them invest in these because they're young. A lot of times, like we talked about, could be 300 months worth of payments left, 200 months of payments left. As a young kid, they have time before they get to college and become an adult. A lot of times you can set up these accounts for them and be able to invest in these again for the long haul. And again, if something gets paid off, all the money goes into that retirement account, goes into that account from that unpaid balance, as well as any monthly payments that were made. So in the climate that we're in right now, financing is getting tough for a lot of people. If you are getting approved for a mortgage, that means that a lot of times you are considered probably A minus type of buyer. Some of the people that are maybe B plus buyers right now are not necessarily getting approved because the cost of money has increased and cost to do loans have increased, and it's becoming a little bit tougher from the bank's perspective on lending. But this is where people can step in and kind of fill that gap. There are a lot of people out there that have jobs, have a decent down payment, and can afford to be homeowners, but because of the state that the market is in right now, they're not able to qualify traditionally with a bank, a financial institution. And that doesn't mean that they aren't good prospects. They just don't dot every I and cross every T for the bank. And if you are someone that has a property wants to take advantage of this equity that's in the property or the appreciation that you have in the property. You don't maybe want to be a landlord or rent out and deal with tenants and expenses and things of that nature. Deal with repairs and stuff like that. You want to think about doing real estate notes or creating a note on the property. This is why we're trying to bring this information to people and get them more familiar, help them create these the right way. And then if you do create a note, one of the things that you can do, let's say something changes for you in the future, and a year from now, 3 years from now, you need a lump sum. You have the ability to leverage the note that you have to get a lump sum. You can sell your note at that particular time, and you don't have to sell all of it. You can sell a portion of it. We'll talk more about partials and buying partials and selling partials a little bit later, as we build this foundation. But, people may say, well, I need a lump sum. You can still get a lump sum. This is what we said that we like it, because it can give you lump sum payments as well as monthly payments. So down the line, you want to go on a vacation, you want to pay for your kid's car, your grandchild's car, contribute to their education, going to college or something like that. You can leverage that note to create that lump sum and then still have ownership interests, in that note if you don't sell the whole thing. Obviously, if you sell the whole thing, someone else is taking over and collecting those payments while you get the lump sum. But if you don't sell all of them, you can still get a lump sum and still retain the rights down the line to receive monthly payments. So I hope everybody we piqued your interest by starting this off today, just to give you a foundation of what a note is and why we like it. And we're gonna, like I said, continue to go on and talk about the specifics of deals and looking at deals and how we go through deals and things of that nature. But now is a great time to consider this particular strategy. And even if you're somebody that doesn't have a lot of money, you don't need 10, 20, 30, 40, $50,000. I mean, if you do have it, that's great, but you can also get involved without having that type of money. So if you have a smaller amount of money, you have the ability to purchase something in your price range and get a good return on it over some time. So don't think that if I don't have a ton of money I can't get involved, because you can. So if you are interested, you can reach out to me, make a comment, make a post, we can talk offline. But I just want to lay the foundation here. Hopefully I did that. If I didn't, please let me know what didn't make sense, what you would like more clarity on. But we tried to explain why we like notes and what a note is and what a note can do for you. So if you have any questions or comments, please post them to this and we'll get those answered. We'll be back next Saturday, 12:30 Eastern Standard Time, going a little bit further into note investing and creating seller financing. If you need to reach out to me, my telephone number is 973-475-8488. Or you can email me at investorgmr@yahoo.com. You can email me your questions there, or text me your questions to that telephone number. Or if you want to reach out, you can do that as well. But hopefully we'll see everybody again next week, 12:30 Eastern Standard Time, either here on Facebook or on Instagram. We're also there as well. Okay, and then we're also Monday through Friday. We're also on the Instagram at Abundant Capital Group. If you want to, if you have a question, concern, something you've been thinking about, want to run it past someone, we make ourselves available there. Just look for us there and, ask your question. Or if there's a topic you want to discuss, would love to kind of connect with people there. But we, try to talk about relevant real estate related articles and information, as well as answer questions. All right, and we'll give more detail on what we'll discuss next Saturday. On Monday, 12:30 Eastern, we'll talk about what we're going to talk about for the next Saturday edition of this training. So hopefully this was good information, and we'll talk to everybody next week. Have a good one.